Hey, welcome to the Exchange. I actually did an investor presentation analysis. Basically, this is a basic documents or the PowerPoint they released with their actual 10K from last February. If you haven't seen the actual valuation video, check it out right now as well too. I think it's a very, very good video. But yeah, let's dive into it real fast. Last thing I want to run through before we kick off, I want to look at the earnings presentation from last quarter. Just probably run through it because it's a little bit different, I think, than most. It's very qualitative. It's not financial in a lot of aspect, which is, I want to see the actual numbers behind the actual growth plan, the actual physical store openings. This is a very qualitative field, so. Again, the qualitative messaging, they are a B Corp, which if you don't know that, basically means a for-profit, almost like ESG focused corporation. That's why they track the carbon footprint, track sustainability is a really big issue for them, which is fantastic. It's great. I'm assuming they're profitable too. It's one thing as an investor, you want to see that profit, you want to see that growth though too, and like ESG is important though too, but it shouldn't sacrifice the entire company as a whole to gain ESG. Which is kind of the big fear for them. Again, purpose-driven lifestyle, so kind of a marketing materials, NPS score, Net Promoter Score basically means basically referral score in a way. It's 85, which is, absolutely fantastic. The customers they do have, they absolutely love them. I love Allbirds personally. I think it's a great brand, a great shoe, etc. The problem is though too, they might operate in a niche though too. Your actual target demographics might be a small niche segment, which is fantastic. It's totally fine. You can't market and spin like you're, like a Nike, for example. There's certain points you have to basically accept reality and be like, hey, we either need to scale down and basically get very profitable very fast, or potentially scale up. And if we succeed, we conquer the universe. Or if we don't, hey, we're out of business at that point. But they're going the scale route, which it is dangerous. It might work, but it's definitely a dangerous route. By gender, by income, and they actually are pretty diverse. They lean more female than male. Incomes across the board. They do skew a little bit higher incomes, which is totally fine. They have more disposable income in general. Product philosophies, etc. Material innovations, our products across the board. This is almost like marketing materials, almost like you find in a magazine, which is a little bit different for earnings report. This is important too. The one thing they put in here is 90% of sales are full gross price. Basically, all it means they don't discount much, if at all. Which that's good. And the big fear is this drops in the future. As they get more competitor pressure or just overall growth pressure, start doing discounts, which will hurt the overall top line. Retail growth footprint. This is like pre-COVID 4.3 million. They're saying they're going to extra 3-4 million maybe with the actual store opening up in the near future. Again, if you think about the revenue base, it's not a massive revenue base though. But think about the OPEX or CAPEX hit for this. Basically, opening up a store is very cash intensive, very cash heavy, and if it fails, it's going to be a very cash heavy wind down too. So that's the big fear I have personally. Key market growth, they're mostly based in the U.S. They're trying to get more internationally focused, which, again, increase the overall revenue base. They have a great product, but it's definitely going to potentially have some growing pains in the near future. It's total addressable market. It's almost like Shark Tank style. Hey, our market's 1.8 trillion. If we capture 1% of that, we're going to be a multi-billion-dollar company. It's kind of wishy-washy. They could get there, but it was not really a set in stone glide path to get there. Again, more marketing materials, more. Hey, we're great. We're more. They do have brand awareness is actually increasing overall. It's only 11% right now of the U.S. knows Allbirds as a brand, which is not that high, so they do have room to grow there too. But again, going back to that niche versus scale play, they might be a niche play, which again is totally fine as long as they market effectively for that niche play. Marketing full spectrum across the board. All I see right here for full multi-channel is, hey, heavy cash burn, no signs of slowing this down at all. It's going to keep burning cash pretty heavily. The 4 Ps or the 3 Ps, what they call of marketing. It really is 4 Ps, and it's kind of a parody of that a little bit, but it's kind of funny right there. Again, new store growth, executive leadership team. All the logos, kind of their backgrounds, etc. It's basically saying, hey, trust us. We're a good executive team. We're not gonna let you down. We're not gonna let you fail. And then gross margins. Again, what you're seeing right here is not hyper growth. It's not gross profits increasing, but it's not bad for growth wise. It's not like a hyper growth scale, almost like a software as a service company would have. And then finally, their flight plan, the very last plan, is how we're actually going to grow and what the plan is. So if you think, hey, we want to grow revenue base, we want to reduce our OPEX expenses. You don't see any of that. You just see fair labor, water, chemistry, animal welfare. Stuff like that, carbon neutrality, which again, this is fantastic though. When you think of actual dollars and cents, how's that company actually going to make money? How's it actually going to grow according to its plan? And you don't quite know that off this material, which is kind of surprising. Again, profit and purpose aligned to win. Hey, this is all fantastic. It's great marketing materials, but financially, it's not really telling you all that much. Then obviously a founder's letter. In the very end, you have adjusted EBITDA reconciliation. This is a waste of time. Don't even look at this. This is kind of made up. I'll explain in later videos why it's kind of a little made up right there. Hey, but that's Allbirds. I'm definitely going to follow their May 10th Q1 conference call, see how they make those changes, if they do at all potentially. But yeah, be sure to sub, like, comment down below, and that's the Exchange.